All right, we're on. We're live somewhat. We got the boys from Ledgerly here, and we got my good friend Bobby Mucka down in Maryland. My good friend from high school. Coincidentally, we found out we were in, or we guess we're he already completed the Mark J. Kohler uh, certification accreditation, and I'm currently enrolled in that. So we crossed paths again online, and I reached out, and now we're here. Now we're live. So Bobby's a good friend from high school, and I want to turn it over to him. Give us a little bit about his background and what he's doing now, and his exciting new adventure into his new truffle business. Bobby, take it away,
Yeah.
brother.
Oh, thanks, Mike. Appreciate it. Ever since high school, I was originally going to the U.S. Naval Academy, but I left after about 3 years because my GPA just wasn't there. Just bordering 2.0 most of the time, but then I dipped below 2.0 for I think it was the second time, and it was my first academic board. They kicked me out of school, and I had to pay back either $144,000 of federal student loans or 2 years of indentured servitude to the Navy. I chose the Navy, so
I
I
love it.
did my 2 years. I was on the USS George H.W. Bush, which is a carrier out in Norfolk, Virginia. I started on deployment. I was like 3 months into a 7-month deployment in Syria, and I which makes me a veteran of Operation Inherent Resolve. Where on that deployment, I think we destroyed about 80 to 90% of of ISIS in general. So we were kicking butt out there in the Middle East. But anyways, I did my 2 years. I got out uh, with a GI Bill. I got 70% of a GI Bill, so I decided, hey, let me go to get my bachelor's. So went to Southern Connecticut State University, got my bachelor's degree there in business administration with a concentration in finance, and got a job as a government contractor, specifically as a financial analyst for DISA. So uh, changed contracts a few times. Now I work for the Office of Naval Research on my for my W-2 job, and then all during that time I started my own business, became a licensed enrolled agent, certified tax advisor under Mark J. Kohler, as you mentioned, and
Zen.
I have started two other businesses as well, including the Truffle Orchard, which, funnily enough, due to the Tax Cuts and Jobs Act, uh, orchards in general, or any plants with a pre-productive period of 2 years or more, has now technically become sort of a tax haven in some circumstances, because before the Tax Cuts and Jobs Act, you were generally required to follow the unicap rules. So you had to capitalize the costs when the production actually occurred. So basically, if I have an apple tree, if I have an apple orchard, I can't write off any expenses associated with um, the establishment of that orchard until it starts bringing in revenue, which is pretty bad. Like that's absolutely horrendous for any business
Right.
owner to be putting a bunch of money, like hundreds of thousands of dollars into something, and then receive no tax benefit for like 4 or 5 years because you're literally watching trees grow until then. And
Right.
then you have to take into account like all the water usage, like everything, because you can't write off anything to really do with that. But if you opt out of those, you can now opt out of those unicap rules to immediately expense these things. So, and then bonus depreciation, for 2024, which is when my orchard is going to be established, I can get 60% bonus
60%.
depreciation on the trees, and then anything else related to the trees, in addition to, Section 179 on like irrigation systems, which offsets my other income, which Section 1, a lot of people don't tell you this, but Section 179, even on like the business return, it doesn't go anywhere on the really business return. It just passes through on the K1
Right.
and goes, and it can write off your wages too. So some people have that like disconnect that the like if you have zero profit or yeah, it won't take you down to a negative on the
Right.
business
Just
return,
just to break even.
but it'll write off on the W-2 wages.
Right.
So a lot of people
That's
get
something they
confused
don't
on
teach
some
you
of
in
that
school.
stuff. Nope,
Right.
nothing. I learned none of my tax law anything in
Yep.
school.
Yep.
Um, in fact, I was actually an EA when I was taking my MBA courses, and in my tax course, we had a CPA, and he would always like just defer to me if because I was the only, I was like we were essentially peers when I
Right.
was taking the class, which was just hilarious because I mean he wasn't even really a tax focused accountant. He just kind of it was kind of like pickup work for him. Like he understood the basics, but he didn't know a lot of tax law. Although to be fair, I wasn't certified tax advisor at that point, but I still knew my way around. I had been through two tax seasons at that point.
Right. Right. So, I mean, for all you listeners out there, you can see that Bobby is just a certified badass on top of being a certified tax advisor. And also, are you sitting for the CPA? Or are you doing the? I know we know you're an EA
Nah.
at the Masters.
So
You don't need the
the
CPA.
only reason for me to get a CPA is if I wasn't going to hire one to just do auditing for me, because that's
Right.
the only thing I that's the only difference between
Right. The peer review
CPA
and
and EA. I can't perform audits and I can't provide
You
my
don't want to
clients
provide
with
audits.
yeah, I don't do that. And then I also don't provide is it audited or reviewed financial
reviewed.
statements. So
Right. Any type
I
of
can't do
assurance.
that. So that's it. I could still do like bank letters and all that. Like I can
Yep.
confirm a tax return, but there's essentially no difference. I don't make any of my money in any kind of auditing, and I don't think I want to. Really, it's not the most profitable thing because I have
Yeah,
out of all of my clients, I only have one that needs an annual audit, and that's a charity.
Yep.
And we
Not for,
just we pay the her other accountant like $1,500, 2 grand for it, and then it's done.
yep.
And that's just for getting grants for her. So that's really the only reason.
Oh, Bobby, I think I told you, but our good friend Andrew over here just recently transitioned from the dark side over to the good side of tax. He was at Ernst and Young doing audits for a
yeah,
publicly traded company,
yeah, for like
huge
almost
agency.
3 years. Yeah, not to dive
Oof.
in too much on that, but like to your point, like where's the fun in that? And with audits, I mean, at least for me, I was touching one client a year. I wasn't really client facing. I was just dealing with managers. I wasn't talking to like directors or anybody with like real decision making power. And
Hmm.
just seeing like the benefit and like how we provide service to clients at the tax level. We're helping them save on a tax bill. We're helping them strategize throughout the year. Like it's much more fulfilling and it's more fun, I'd say.
Right.
But yeah, I do not miss audits.
Yeah, I don't blame you, especially over EY, where you were probably underpaid for the amount of work that you did.
Yeah, it's definitely well documented.
Yeah.
Yeah,
Better
I
flipping
when
burgers at
I was
McDonald's.
oh sorry
No, no, go ahead. I was just saying
oh
flipping
so
burgers at
when
McDonald's pays more.
yeah right so when I was about a year into my tax business, I had grown pretty substantially. I went from like basically making no money to making 70,000 $70,000 a year at that rate. So during that first year, I thought, wow, I could actually like do this. Originally, my business was just like bookkeeping on the side, maybe $500 extra a month. That'd be cool. Cover the expenses plus make a little bit extra cash on the side. Because I was like, all right, cool, yeah. Just in case something happens, I get a little bit of cash built up. Then one client turned into like 5, 10, 15, and so on. Then I added tax, and when I added tax and became a licensed enrolled agent, I figured, well, would I be able to make this like a W-2 job too on the side, or would I just be able to have to just like, do that? maybe I can get like a management position or something because I can show like, oh, hey, I grew my business from zero to like $60,000 in, sub 2 years. Like that's excellent. And
Absolutely.
maybe I can add value to, another like partnership or LLP, something like that. So I started like looking around for like other accounting positions. I then like interviewed for BDO, and they said, hey, like we'll make you an experienced tax associate for us, but you can't, do your business anymore. And
Right.
I was
Conflict
like,
of
oh,
interest.
that sucks. Well,
Yeah.
I mean, what's the salary? And they're like 67. And I was like, I'm making that already. What like
Right.
what is this
Pitch it to
is
me.
this a
Like, give me
joke?
something else. Is there
I
more?
told them what I
Right.
made currently, and I was just like, is this a joke? And I got the offer letter. Um, I should probably pin it on my wall somewhere just to say like, oh, I could have gotten into BDO, but the money wasn't there, so I just have it on there for motivation.
Right.
Yeah, that's funny
But
that they had the nerve to come to the table with that sort of offer.
I know, right? It was ridiculous
Like, use
because
like
I
a
was I
little
was
common
literally
sense. Like,
making
this
that.
man has built a business. He's already up over 60 grand, and like now you want to give him a paycheck where you're just gonna withhold like 2/3 of it.
Right.
Exactly. And then that's when I realized like I'm never going to get a job in accounting. I'm just going to work in my own business and
Yep.
you know, focus on that. So, since then, this year I'm expecting about 250 in revenue.
Excellent.
That's
So,
awesome.
we'll see. Hopefully it's a little bit more. Last year I had a goal for 150. I ended up doing 120 overall, which not too bad. A lot of that actually came on the latter end of the year because of honestly because of Mark's course. I got so
Yeah.
many referrals, and it was just phenomenal. Like
When did you
the
sign
whole
up
the
for
whole
his
time.
course for the
I think it
certification?
was back in. I think it was late July, early August,
Of
around
this
there.
year or last year?
Yeah, of this year.
Oh, wow.
So I've been with it a couple months, and I've definitely earned all my money back plus a lot of profit.
Yep.
Um,
It's awesome.
I also did the payment plan option, so I actually already paid off the whole course before I even paid for it,
Yeah. That's what we're
which I
that's what
thought
we're
was
doing too.
hilarious. Yeah, because literally the first like I think I passed the whole thing within like a week. Because I was just like constantly looking at the videos, did the tests and all that.
Yep.
And then I got one of my first referrals from them, immediately did business, paid for the course, essentially, because it's bookkeeping client.
Yep.
So there was like, what, 7,000 a year, something like that, before tax return. Because I don't, he says to uh, bill the tax return into the fees. I don't do that. I just give them a discount.
Mm.
So I
Okay.
throw my clients, especially bookkeeping, if they do like bookkeeping or tax advisory with me, I throw in a 15% discount on tax prep. So
Hmm.
they're incentivized to do that with me. And then I still get that big cash inflow mid-year.
Right. Right. Here's a
So
question for you because Mark pitches this and markets it as like, hey, become a tax advisor with the certification program. So like what because like we're doing everything, bookkeeping, accounting, tax planning, tax prep. What percentage would you say the clients that your leads from Mark's program are generating? Are they mainly just bookkeeping clients? Are they mainly tax advisory? Like I guess like what would be the breakdown
I would
of
say
what
it's
you're
close to
seeing?
50-50. A couple of them are business owners, a couple of them are just real estate. Other ones, they don't want to pay for bookkeeping or something. So then
Hmm.
I'm just like, well, we'll do tax advisory. And what I do with that is I'll meet with them. I also deviated a little bit on the dogma this way. So instead of just offering quarterly and monthly, I offer semi-annual, quarterly,
Hmm.
monthly.
Hmm.
So then semi-annually uh is the least amount of work for me, but it's not it's $150 a month instead of 250.
Hmm.
And then monthly is obviously 600, so I kept the 250 and the 600 on that scale.
Yep.
But then the 150, that's where I would make the most profit based on the amount of hours that I actually spend on it. Um, so in those cases, yeah. But I also make myself very available to each client. So I offer year-round tax support for any tier that I use. Like I give them my personal cell, they can text me, and I say, I'll get back to you within 48 hours with an answer. So that in of itself is difficult.
Yep.
So that's mostly what they're paying
Yeah, but
for,
you're providing
is
great value.
to have that. Yeah, exactly. And most accountants in today's market, the biggest complaint that I usually hear about other accountants is that they're not responsive enough.
Yep.
Yeah.
And if you fix that, clients are more likely to stay with you in the long run because they feel like they're valued.
Yeah,
That's
for
number
sure. If you're
one.
just out here playing email tag, and that's the only way you're communicating, it's just easy for an accountant just to look at it and be like, I'll get back to it, and then just obviously never do.
Right. Right.
Yeah, so that's something
Yeah.
we do as well, with providing the phone number. It's like, listen, reach out to us with any questions, or, you want to hop on a call, whatever, just let us know. We'll get back to you in 24 hours. And yeah, it is
Mm-hmm.
difficult, but I mean, that's why, they're
Yeah.
paying you what they are, because you're on top of things. You're
Right.
showing them that value.
If you give them that little
Exactly.
pulse, that goes a long way. It's like, hey, look, I got your message. I'm not going to be able to look into it just now, but I'll get to it within the week or 48 hours or whatever. But if you just give them that little response, that little pulse, it's like, oh, okay, that's all I needed. Like making sure it doesn't get swept under the rug. Um,
Mm-hmm.
that's a big, that's a big piece of the pie.
Is it cool if I ask a question before I got to dip out of
Yeah,
here?
yeah, go for it.
All right.
Shoot.
So just after like kind of when you're opening on, just your background and everything, because I've only been really surrounded with CPAs. Like I don't think I've ever met an enrolled agent. So like when you were going through that process, like what was the decision? Like what were you looking at? Like did you ever consider the CPA? Like what I guess steered you towards being an enrolled agent?
Oh, that's a really good question. Yeah, so enrolled agent, obviously, you don't have to have the credit requirements or even a degree to get it. Um, which, I had a degree at that time. So, like, I qualified for the CPA, but I didn't want to put all of the hours and studying to something that I didn't really want to do, specifically like the audit sections of the CPA exam. Um, and then I thought, it's like, well, what's like my cost like benefit analysis here? So like, yeah, I have one more test to do with the CPA than I would the EA, because EA, very tax specific. You have the SEE for part one, which is the individual taxes, part two, which is business taxes, and then part three, which is taxpayer representation. Um,
Okay,
of
so yeah,
which,
it's very focused on
yeah,
taxes.
it's extremely focused on tax. All it
Ah,
is tax. Um,
yeah, just circle
the
back.
one thing that the part three doesn't do is it doesn't teach you how to like respond to the notices and all that. So you still have to do a lot of more research and um, get guidance from people that have been doing it in the field a while. But other than that, like it's fairly easy to talk with the IRS in those
Gotcha. I
cases.
was just gonna say this to circle back to, I think you were maybe in a class or something with somebody else who was a CPA, and he was just deferring to you on all the tax stuff, like something you don't think about. And like definitely when I transitioned from audit to tax, I'm like, I know like some of the codes and regs, but like I definitely don't know like enough to just like hit the ground running and start doing tax returns. Like,
Yeah. It really goes into show that it doesn't matter what the credential is. It depends on who the person is behind it,
Yep.
and it's who you try like to pick a good tax advisor or, CPA or EA in general. You have to find who meets your needs adequately and who can save you the most money. Legally, of course, because you don't want to get hit on tax evasion. I know there's 4 tax preparers over in Tampa. I read on a news story today they got caught for fraud because they were. I think they were also guaranteeing like refunds
Mm.
for something. That's
Yeah.
a big no-no. Anybody listening to this, if they're saying they're going to guarantee that you're going to have the biggest refund from them, they're probably trying to get refund shoppers, and it's going to cost you in the long run because
Yep.
usually it's not the taxpayer that gets hit. Usually it's just the taxpayer, because when you sign your name on there, that's penalty of perjury on you.
Yeah. And even for CPAs too. I mean, in the ethics
Hmm.
code, it's having that
Yeah.
contingent like, hey, if you do this, we'll guarantee you we're saving this. Um, it's a fine line. I mean, unless you know you can specifically save them money, like with an S corp election, it's like, all right, you're gonna save. We know you're gonna save X amount in taxes if you show
Yep.
this amount of profit. You can forecast that for them and just show them the numbers. Like, here's the whiteboard. Here's the numbers. Like, that's going to save them taxes. But if you're guaranteeing a refund or guaranteeing money back, there's probably something fishy going
I
on.
saw it with there was
I don't know if I
another
got accused of.
accountant
Yeah.
that I had clients come from to
I'm gonna
me,
start packing.
and I noticed on their Schedule A that they had like that from the prior year. They had about $10,000 in charitable deductions plus another $500 in non-cash contributions. So I was like, okay, so they must know the tax code, like under the $500 limit, they don't have to do any of the extra filings and all that. So it's like, yeah, sure, whatever,
Yep.
whatever. But then I noticed on the current year return when I was doing it, like, hey, you guys didn't do any contributions this year. You had like 200 and something dollars instead of like 10 grand. Like, what's the delta? Is something going on? And or did you forget to give me something? And they said, no. And I was like, oh, yeah, because I mentioned, because last year they did like 10,000. That's why I brought it up. And they're like, yeah, we didn't give 10 grand to anybody last year. And I was like, oh,
Oh boy.
uh, okay, would you be able to give me the past 3 years of tax returns? Checked all of them, similar numbers every single year. So I was like, yeah, this either you didn't read the returns, well, obviously you didn't read the returns, or you probably just didn't notice. But their tax preparer had been inadvertently, well, in, to them, inadvertently committing fraud on their behalf. Uh, So they've been getting excess refunds, and we had to amend to get it all taken care of. Unfortunately, I think they ended up paying about 15,000 out of pocket,
Wow,
plus
probably mainly.
penalties and interest.
Yeah, yeah. It was probably a lot of penalties and interest because
Yep.
what is it, $10,000 deduction? I mean, what's that only going to impact their actual tax minimally, right? So,
Yeah, that's gonna hit like,
oof.
well, assuming they're in like 22% bracket, effective rate probably 30% at that point. It's probably 2,500 a year,
Yeah,
25 to 3 grand a year plus
30,
state.
yeah,
So
state,
yeah,
30%
and
accruing
then
every,
penalties and interest.
yeah,
Luckily, over those couple years, it was pretty low,
right.
but it was nasty. But
It's, I have a follow-up question after that, but I know Andrew's got to hit the road.
Yeah, so I did want to ask one question again, following back to what you were talking about at the very beginning. So you have an orchard, right, for a
yeah,
truffle business. So I always thought that land was not depreciable, right? But obviously you have trees or apple trees or whatever it's going to be, and you
hmm
talked about depreciating those.
depreciable. That's depreciable over 10 years.
And you could depreciate those, just to be clear, because they're part of the operations of an orchard, right?
Correct.
Gotcha. So in any other business, I'm guessing we're not depreciating trees.
Probably not unless you're doing
Nope.
harvesting. Like when I was at Bigelow, the tea plants themselves. I know Bobby and I talked about this down in on the plantation in South Carolina. Those trees, those tea leaves, were considered assets, so they were harvestable, and we would just reclass inventory based up into there. And I can't believe I'm talking about this type of accounting. I thought I was out of corporate accounting. Yeah, all of
Well, I was out there pulling me back in.
yeah, yeah. There was some dude in the tea leaves, and he was dragging me back in. Um, but that's an awesome question. I know it's
Yeah, well,
weird to
I
think
mean,
about.
we deal with it all the time, right? Like, all right, what was your depreciation this year? Like, all right, I see land, I see buildings, equipment. Like, all right, land's not being depreciated, and I'm
Right,
just like, trees depreciate. I'm like, well, it makes sense. It's the operations of an
right.
orchard. Like, you're using those for the business.
hmm
So just wanted to call that out for our listeners, fellas, everyone. Bobby, it was nice to meet you. I gotta run.
All right, brother. I'll
All
talk
right.
to you later.
Yeah, you guys have fun.
Good
Nice
luck
to meet
in,
you, Andrew.
Andrew does how do you say it? Jujitsu?
Jiu-jitsu.
Jujitsu.
Oh, he does jujitsu. I did
He
judo for a
does.
few years, and I also did Shotokan.
Another
But
certified badass over here. I got to start getting back into the gym.
and so it's like what I'm doing with my truffle orchard. Like you can buy into the partnership for $25,000 minimum, and you get 120
Right.
units of 10,000 that are
Right.
available.
So take us through that a little bit, Bobby. I know you sent me the YouTube link. I've still yet to watch it because I'm trying to
Hmm.
take my spare time and get through my Mark J. Kohler accreditation, which
Yeah.
is almost seeming like I'm chasing it, I'm chasing it, I'm chasing it, and I'm not getting to the end. So I definitely need to watch that. But take us through like the high level picture of what's going on with the truffle orchard.
Yeah. So essentially, the way I have it planned out, actually, let me pull up some of the financials here. It's
Oh,
fun. Um,
love it.
yeah. So what's planned right now is 15 acres in Maryland. I'm not going to disclose the location on here because the truffle industry is very violent in some circumstances.
Mm.
So
I'm sure they're subscribed to
only
Ledgerly.
partners will know where it is
Hmm.
until we've at least broken even. Then we
Yep.
might do tours and stuff. Specifically, the species of truffle that we're growing is the tuber melanosporum. So this is the most expensive type of black truffle, which is in the Perigord, which was originated from the Perigord region in France.
Hmm.
Um, right now, Spain is actually has the highest productivity of it. But back in the day, back in the early 1900s, France was pumping out about 1,000 tons of this specific truffle,
Wow.
which meant that it was very cheap. Um, now the price is 2,200 a pound retail and about 1,250 a pound wholesale, I would say. So you can get about 65 to 125 pounds per acre
Yep.
of trees that you have for it. But it takes about 5 to 7 years for them to actually grow. So, uh, assuming that you're doing well, we're going to start with 15 acres with the potential to grow up to 30. Um, I had the CAGR for it, compound annual growth rate, is about 8.5%. For my model, I have 4.5%. So I
Okay.
discounted that pretty heavily on that. Even so, I'm looking at about a 50% IRR over 50 years.
50 years. When are you forecasting a so I know revenue within you said 5 years about?
5 to 7 years, with the 15 acres, and year five, we should get $376,000 in net profit after all
Oh,
said and done. And that
with a
is
profit too. Okay.
that's going to be the first ever harvest, which is about 25% of capacity.
Wow.
Um, and that's only at 15 acres. Like we'll probably expand to double that. And so year six is 802 or 803, rounded up. Then 1.2, year eight, 1.7, and then nine, it kind of evens out. That should be at max capacity. About 1.77 million in net profit
Wow. Wow.
annually, of which I'll own about 75% of that because I decided to take the mortgage of the land and all that under my name and
Hmm.
all of that. So I have everything under contract and we're like ready to go, essentially. It's just a matter of collecting wires from partners for operations at this point.
So when would the cutoff be for those wires to have additional partners within the business?
So for now, it's February 15th, is like the last day for me.
Hmm.
Um, but because beyond I mean, that's when we're signing contracts with the partnership, which is when because I have it on convertible note, and
Yep.
that's when the conversion occurs. So then instead of just me being in there, you're going to have all these partners, and in the operating agreement, like we all need to be in agreement that we're going to that I'm going to be selling more units and stuff for additional capital raise. So that's sort of how that's going to work, because the goal is to keep this as few partners as possible, but make it as profitable as possible too.
Sure.
So
So what does the forecast of the tax benefits look like for the first 5 years, and then
so for the
income
first,
potential for the
yeah,
partners?
so first 5 years, let me just actually I'll share a screen for this
Yeah.
because it'll actually make more sense looking at it than me just saying it.
Perfect.
So let me just go ahead and oh, we have white. Can I do a whiteboard
You
on
can
here?
you can for
Oh,
sure do a
perfect.
whiteboard.
All right. Okay. Okay, so I do not know how to use that. So I'm just gonna open up Paint in my in share screen. All right. Share screen. Here we go. Okay, you see it?
We got it.
All right. So let me go ahead and refer to my whiteboard here. So I had it written down, sort of. Okay. All right. Here we go. So using, okay, I have the wrong thing on there. Whoopsies. That's not big enough.
Let's try. There we go. Is that easy enough to
There
draw
we
on?
go. Yeah, it's fine. So utilizing IRC, that was messed up section.
160.
168K 5, and you exempt yourself out of the unicap rules. You can, well, for mine, for 15 acres of these trees, because they're inoculated with the truffle spores,
Uh-huh.
you're looking at about $195,000 up front for that.
Okay.
Well, that's you pay 50% up front and then quarterly payments.
Yep.
Um, and then around 405K. Oh, I'm sorry, wrong. Sorry, 405 was the total there, but 210 of other expenses plus like interest and financing, all that.
Yep.
Um, so this is going to be other. So from this, we get 60% bonus depreciation.
Yep.
So that's going to be about 117K right there, I believe. Hold on. You just redo that math really quick. I'm pretty sure I'm right, but 114. 114. I don't know why I thought 117, but 114. Then we've got,
No, you were right. You were right.
that was 117?
195 times 60. Yep, 117. Yeah,
Oh my God. You know what I
it's a
did?
pretty number. It's a pretty number.
Yeah, there we go. You know what I did?
117K.
On my calculator, I put 190. So that's what it was. Yeah, so 117. And then from here, because we're going out of unicap, we can expense all of this stuff through section 179 and various operating expenses, because this is officially in operations due to the Tax Cuts and Jobs Act.
Yep.
So from that, the total from this would be 327K in expenses. I get, because I'm selling about 25% of the company, I get 75% of that,
Mhm.
which is
327.
245.25. So 245,000, about $245,000. That's my total expenses
Yep.
from that'll get issued to me on my K1, and then everybody else in aggregate would get 1.75, 81.75. Sorry.
Yep.
So if your average is, let's say, you get the minimum, you have 120 units, so that's going to be 1.2%. So that's going to be 327, about $3,924, which if you put that over the initial investment of 25,200,
Mm-hmm.
because I'm selling it at a valuation of 2.1 million.
Okay.
25,200, you get to write off 15 and a 0.57% of the investment, or more like the contribution, because I'm not selling securities here. So, and it comes with what you call it, voting rights. So you are a
Gotcha.
legit like partner with like quarterly meetings, whole nine yards. So from that, that's not too bad. Getting to write off 15.5% of your contribution
And
into a business
yep.
right there, not too shabby.
Now, would this be for tax year 2023 or 2024?
This would be for 24.
For
So
24. Okay.
this is what I'm planning already a year ahead. So remember
Right.
when I said that I'm gonna probably hit about $250,000 in revenue
Mm-hmm.
next year?
Look how
What's
much
my
you're writing
share?
off. Five thousand
Exactly.
dollars in
So
250 in profit
revenue.
revenue.
So it's gonna be probably the rest of the because I have expenses. So, but
Of
I have
course.
a pretty high margin because
Yep.
I'm a solopreneur right now.
Yep.
But I am hiring someone next year.
Yep.
So it's probably gonna look like more like 200, 225
Yep.
tops. I don't think I could go, expense less than that.
But
But
you got 60% bonus depreciation, which can bring you into a loss, unlike
yep.
179. So it's gonna be a nice Christmas
Oh,
for you guys.
by the way, that is that's not including the regular depreciation rate too. So
Right.
these still depreciate prorated based on when they're established. So these would get established in November. So
Yep.
I'd have 2 months of just regular 10-year depreciation on
Right.
top of that.
Right. For the
So it
remaining.
would be probably like 125 or
Yeah.
something like that.
Excellent.
Hmm.
Yeah, this is great stuff, Bobby. Um,
And it's not something that most people would even consider because a
right.
lot of people don't want to get into farming and stuff like that. But Tax Cuts and Jobs Act literally made these things a tax haven. So I'm gonna get because owning a truffle orchard has been one of my little dreams since I got out of
Yeah.
the Navy.
What stupid question. Why truffles?
Uh, well, I first tasted my first truffle dish when I got out of the Navy, and I fell in love immediately.
Yeah, okay, gotcha. Yep.
My wife buys me all these truffle products, and I was big into like the truffle hot sauces and stuff. Then I started getting more into it, and I was like, well, how can I, I'm a finance guy. How could I like monetize this? Can
Yeah.
I even grow this in this country?
Yep.
And turns out you can. You just need the right partners for it. Um, so I have a lot of research. I have like scientists backing me on this, and we're getting through those hurdles. And I've already tested the soil and everything.
Yep.
We have climate data to back us. So this location that I found is good for the next 50 years. Um, and I've seen competition pop up.
Hmm.
Um, recently. So I have a irrigation contractor that I'm working with. He set up a. Do you know who the CEO of GE is?
Not off the top of my head. What's his name?
Larry Culp.
Oh yeah,
So
yeah, yeah, yeah.
Larry Culp is supposedly, and I heard this from the grapevine, but I kind of believe it.
Is he a truffle
Suppo
savant?
so he set up another truffle orchard uh over on the eastern shore of Maryland, supposedly.
Okay.
I don't know where it is. Somewhere over there, undisclosed location. Um, but I found out, I asked more questions and I found out, he might not be running things as well as it should be. So we'll see. I'm not gonna give out too much information on it, but it looks like he don't know what he's doing, which is really good for me. It also depends on what type of truffle he's gonna start producing and
Right.
stuff. So I'm not really too sure. But another reason that I've started this is for conservation purposes as well. So there
Hmm.
is obviously a huge profit incentive, but all the literature dictates that this specific species of truffle will be extinct by 2050, if not by 2072. About 95% of all of the production in Europe is going to go away.
Wow.
And I mean, it's already down 98% from its all-time high in production. And they're still planting 1,500 acres a year, and they're barely scraping by, staying even on that. And the prices are still going higher.
Right.
Um, even Kim Kardashian's private equity group just purchased a minority stake in Truff, which is the truffle hot sauce company.
Boss. Yeah, yeah, yeah.
And all of these things just happening together, it just makes me very, very bullish on this
For sure.
sector. So that's why I'm trying to reach into the market and then create the largest truffle orchard, well, or group of truffle orchards in the country, which when I get to 30 acres, it probably will be.
All because of a simple love of food,
Yep.
which is
And
the coolest thing.
I mean, with 30 acres, all those I was telling you the financials of 15 acres. 30 acres doubles that.
Double it. Yeah.
And that was also, let me see, was that my optimistic? That was based on 100 per acre. So obviously it can go a little bit less than that. I would say probably closer to 80 is the best for it, but most of it I basing on selling it wholesale,
Yeah.
but obviously there's a lot of people buy it retail too, which it is like a 50 to 100% surcharge on
Yeah.
buying retail. And my research partners, I do a nice revenue split with them, so they're incentivized to help everything grow because they don't really get paid until we're selling truffles.
For sure. What is the I know we were, not to get too much into the nitty gritty tax law, but on the accelerated depreciation methods, for Maryland, how does that work? Does Maryland have an add back on the state side, or is it 100% benefit, or how? What are the rules like on the Maryland side for the accelerated portions?
Ooh, that's a good. Oh, that's a good point. I'm pretty sure they just follow federal tax law in those
Oh wow,
circumstances.
not like Connecticut. Connecticut's the worst.
Yeah, Maryland's not bad when it comes to taxes.
So
Um, and there's like we got the 529 plans,
yep,
deductions and all that. So, um, I mean, you could even donate deer meat and you can get state tax deductions.
Yeah.
So they
Well,
incentivize hunting and everything. It's actually really great. And then there's also incentives for planting trees, uh, which I'm looking into a lot of those state grants. And I know for veterans, you can get up to a $50,000 business loan at 0% interest, payable over 8 years.
wow.
Yeah, so I'm gonna probably be looking at that because this is gonna be a veteran-owned, hence, I'm a veteran.
Right.
Um, and most of the people that are also putting their money in are also veterans too. So hence I've made the company Valor Orchards. So I've so dubbed it. But
That's freaking awesome. Yeah, this is a really exciting time for you, man.
oh
Successful
yeah,
business, growing another business for what you love. I mean, because who really loves taxes? I mean, I can't say I love taxes, but you're doing something on the like say on the side now, which has the potential to grow into something crazy, crazy good, crazy successful, and all for the love of truffles, which is freaking
yeah.
great.
And based on everything, by the time I'm 40, which I'm turning 30 in like literally a week. By the time I'm
Wild,
40, my kids are going to be, my first son's going to be 9 years old,
right?
and that truffle orchard is going to be at full capacity, and it's going to be what, 2033,
Yep.
2032. Uh, by that time, I think about 50% of the production is going to be gone from Europe.
Wow.
95% of all truffles that come to America are from Europe.
Right.
So you lose half the supply. What happens to the price? Shoots up.
Yep.
So
Time,
we're
that
gonna, that
time value of
those
money
prices are
too
gonna
will
go.
even be more advantageous for that situation too.
Oh yeah,
And then
oh yeah,
you'll take one out of our what we learn in our Mark Kohler course and open up the family management company, pay your
oh of
kid through
course,
there, open up the Roth IRA if the Roth isn't phased out by then.
yeah.
Um,
My son's doing May, so he's gonna right first couple of months. We're taking photos, doing
yep,
modeling. He's
yep,
gonna feature it on my Instagram, my Facebook,
yep,
and on top of that, it's gonna be on my website for family tax planning, and we're gonna pay him, reasonable modeling fees
yep,
for all the hard work and effort for
yep,
managing them,
yep.
and he's gonna make a good amount of money.
Yeah,
Luckily for Maryland, they follow the federal standard deduction for filing your return. Like they have the $3,000 exemption,
uh-huh,
which I wasn't 100% sure how it works, so I literally just plugged it all in my tax software, and it was like, okay, well, I can just pay him up to the standard deduction. It doesn't
right,
proc state tax return anyways.
right.
So he's gonna get probably enough to max out a Roth for 17 years in a row, hopefully.
It's awesome.
Yeah,
That's just building, setting your family up for success.
yeah,
Um, Dude,
tax
so
free.
I need to give that YouTube video a listen. I'm gonna send it to Andrew too. I know he was asking about it. Um, so I'll for sure send it with him. Okay, not to pivot too drastically here, but I wanted to pick your brain on that question that I had.
Shoot.
So like similar to us at Ledgerly, we're a partnership, 50-50 split.
Mm-hmm.
Um, like let's say that Andrew and I both have our own S corporation underneath. How
Mm-hmm.
does the transaction work to pay? Like, let's just talk about my S corporation. How
Okay.
does the transaction work to take my 50% and pay my S corp? Is it only the K1, or take can I 1099? Like, let's say we had $50,000 in revenue and whatever, we had 10,000 of expenses and we had $40,000 net. Can we 1099 each other $20,000 each?
Oh, I wouldn't 1099. No. So here is the general. I'm going to share my screen again.
Yeah.
So here's the general That's generally what you're supposed to do. All right, so we have your 1065
Yep.
partnership.
Yep. Got the S corps down here.
Yep. Okay. So, I'm just gonna put this is yours, Andrew's. All right. So, essentially, you're kind of right on the K1 part. So, obviously, those profits are going to split 50-50
Yep.
on each of your respective S corps.
Yep.
So, the way that you're going to do that, though, is that from those I would probably just do from because the way it can actually split is you take out distributions
Yep.
through to that, which obviously in this case you're gonna have to take out 50%. If one of you takes out 1,000, other one has to take out 1,000.
Yep.
So and so.
Yep.
So let's say you make 50K in profit, right?
Yep.
Okay, in that case we're gonna have a 25K split down here, down here.
Yep.
So over here, there's no like obligation to pay wages. Obviously, it's not you're
Right.
not supposed to pay wages out of partnership to the
Right.
partners.
Yep.
So the 1120S, though, this is in itself is a management company. This one
Right.
does not perform the actual work. It essentially puts you in the position to work for the partnership here. So
Correct.
this is managing you in that case. So you're managing yourself. Um, so you would pay yourself wages like what you would pay anybody to like manage yourself in that case.
Yep.
For this low of an income, you'd probably take more wages than not. So you'd probably take like 20K in wages, which obviously subject to self-employment tax, and
Self-employment.
then
Yep.
5K distribution
Mm-hmm.
on that. So that would be your yeah, that'd be just your distribution on that. So that this would be past the 25K K1, boom, then 20K wages, 5K goes in the K1. So that's how that would kind of go for that. But
Right.
anything split for that actually goes to the companies, that's going to be based on the K1s.
Right.
Based on the K1s, but obviously if you have like depreciation or anything in the 1065, you can essentially empty out, capital accounts and everything to your S corps. So
Right.
let's say you had $100,000 in total capital accounts and you both equal 50-50 on that. So
Yep.
you could each take out $50,000. Obviously, you're only going to get taxed on the 25
Right.
because the other 25 there's no tax on distributions.
But then that 50,000 that we're taking out as distributions from the partnership,
Correct.
that goes into the S corp
Hmm.
as would that go in as
It's a distribution to the S corp.
but would that go in as revenue to the S
Nope.
corp?
Nope. Because the S corp is a partner. So partners can get
Ah,
distributions. Yep.
because the 1065, so like let's say we add a zero and it's not 50K, it's 500K. And
Hmm.
now it's $250,000 K1.
Yep.
That partnership K1 to the S corp is adding to the S corp's income, correct?
The the K1 is what would add to the income of the S corp because whatever the
Right.
partnership makes, 50% of that is going to get passed through to your S corp of
Right.
Andrew. And then so yeah, let's say it's 500K, then we've got 250K goes to your S corp. Obviously, we're not going to do that high of wages,
Right, right,
but we're not going to do just add a zero here. We're going to probably want to minimize that.
right.
So we would do something like
60K, something like that.
for this, I'd probably go like 75 for that because you can
Yeah,
argue
30%.
that you're an accountant. That's what you would pay on
Yep.
average, accountant with a couple of years experience, yada yada yada. And then the rest of that, so this would be 175K
Just
in
right.
distributions, which obviously you're going to pay tax on this amount. Obviously, this part subject to self-employment, but let's say you have let's also say there's 500 no, let's say there's 800K that is the basis and for both of you
Mm-hmm.
and like split down the middle. So 400K goes to here and 400K
We're
goes here.
we're talking actual cash distributions here,
Yes, so this
correct?
is cash
Yep.
distribution, and this would be like, let's say you had something in your operating agreement says like end of the year, we just pay out distributions of everything. Make it just to make it super simple.
Right.
Obviously, you're going to want to keep money in the partnership to be able to afford expenses on there. Um, Also, obviously, we're not including any expenses in the 1120S right now. So,
Correct.
yeah, so we're
So
we're we're not doing that.
you're on track to answer my question now. The
Yeah.
and I'm sorry, this is cool for like all the viewers out there, like the whole flow chart of how it works. So that 250K of profit gets taxed, even though it's on. It gets taxed in the S corp, even though it's not a cash transfer. But the 400K distribution from the partnership to the S corp is actual physical cash.
Yes,
So
which would not be taxable unless the only reason why a distribution could potentially be taxable is if it is in excess of basis,
correct. Yes.
which
Yep.
and that's why, we always say you can't go negative on your basis
Yep.
in general because it resets because that would be capital gain, which
Yep.
is then taxed at capital gain tax rates.
Again, yeah. Yep.
So,
So, so now this 400K, it goes
mhm.
into my S corp. It increases my cash, and does it just go to, due to Mike as a liability, or it just goes to my equity account on the balance sheet?
So it would so essentially I kind of just did it here. So this was the capital accounts for both of you. We crossed
Yep.
that out. This
Yep.
goes to zero.
Yep.
This goes up to 400. So
Yep.
now your equity account in your basis in your S corp is now 400K
Gotcha. Gotcha.
higher.
This makes sense.
I'm not even a CPA.
Yeah. No, no,
Right?
This makes sense because the way, and I love Mark's course, but this is the step that's missed in the way that it's accounted for coming out of the partnership into the S corporation. I was under the assumption of, okay, well, my distributions that I'm taking out of the partnership, it's not an expense on the partnership.
Nope.
So does it go in as revenue to my S corp? That doesn't sound right. But this
Nope.
makes sense. The equity is just changing hands from the
Correct.
partnership to the S corp.
Exactly. And then obviously you can this would be what your actual and this is where phantom revenue comes in play. So like
Mm-hmm.
if we kept all of this and took no distributions out of here, you're still going to get taxed on this no matter
Correct.
what.
Correct.
You're still going to pay those taxes. You're just
Yep.
not going to get any of the benefit of taking the money out of the entity that is creating the revenue and some of the expenses.
In and here's the crazy thing: we're zeroing out the equity. The 8,000 goes to zero. But I wonder if the thought has been to just zero out the profit and loss, so you're paying zero tax on the partnership level, and
Well, you
then
wouldn't pay any tax on the partnership level anyways, because it's all passed through. Even
right,
on the S corp, you'd still pass through to the partner,
because
the
in
owner
theory
of the
the
partner of the
in theory the self-employment hit is
S
coming
corp.
out of the W-2 on the S corporation side.
Correct.
Gotcha.
That's where it will pay tax there, but
Right.
that's about it.
Okay, this makes sense. I'm still like hazy on like, oh well, what if we just 1099 the partner the S corp, zeroed out the profit, but whatever. This is perfect. This
You
makes
could
so
also
much
do the
sense.
funky thing, and if you don't take any distributions out of, so if you didn't take any distributions out of the 1065 here, technically you wouldn't be able to take any out of the S corp, which then negates the need for wages because you only need to pay wages if you take distributions.
Correct. Right. Right. So in
So
theory,
there
you
is
can have a
that.
in theory you can just be set up as an S corp. Um, and if you right, so if you don't have the distribution, like if you don't take a distribution or your profit is zero or at a loss, the owner doesn't need to go on payroll. So you're well, at least for that year. But
Yeah. If they did take distributions, though, even if they are at a loss, technically they do still need to pay themselves a reasonable salary.
right,
It's just, what is that? Is the
right.
question.
I know
Because it's bringing you to an even more greater loss.
right. It's a
But
super gray area.
yeah, I've seen a lot of people say, you still got to pay yourself reasonable salary, and then I'm like, all right, well, um, like for my S corp, technically, I'm only working, I don't know, less than half time.
Yep.
I'm not working full time because I got a full
Right.
time job too. But then I'm like, okay, what would I pay someone to work per hour? And I was
Hmm.
like, okay, well, maybe work like 2 hours a day on average,
Yep.
365. So then I'm just like, okay, well, like 30, 40 grand salary. Like, all right, cool.
Yep. Yep. Well, this
Makes it
clears up
easy.
the fog. It's really that distribution piece from the partnership to the S corp and how to properly account for that.
Yeah.
I think it's that missing.
Equity usually remains in equity accounts in these circumstances. So if equity is being transferred from one entity to another, it's going to decrease the basis in one and increase it in the other,
Right.
essentially.
Like a do
So
to do from. Um, but yeah, like it's almost like a reclass between the entities.
yeah, it's literally just a paper transaction at that point, just
Yep.
a manual entry or just a recategorization of
Right.
something, which is why I'm always asking people with multiple entities, "Hey, is this revenue or is this equity? Did you put more money into the business?"
Yes, I know. You know,
And I
it's
hate because I'll see like $5,000 exactly somewhere, and I'm like, "Is this what is
yeah,
this? Is this revenue?" There's no so annoying, but
yep. It's like, hey, man, we don't want you to get taxed on something that's already been taxed. So,
yeah.
you know,
But this
it,
is this here, especially like phantom income, this is like actually one of the issues with a lot of partnerships. So for distributions, you do have to make sure that you have something in writing that, like, let's say you have to distribute 90% of the cash at the end of the year or something, or like by quarter or
yep,
something. Uh you should make sure that you do that because if you're trying to figure out what each partner's tax liability is, if they only take out up to that, then there's going to be like differences in capital accounts to make things very weird and uneven too. So it's usually just make things easy, just split it,
but yeah,
and then make sure that things are good to go that way because it just capital accounts get so messy.
I
I hate
know.
dealing with them, but
Yeah, I mean,
it's that's
especially
that's my job.
like each partner has their own S corp. It's pay for your individual expenses out of the S corp,
Exactly.
and keep the partnership income, keep the partnership expenses. Everything else is
Yeah, like if you go to
is
a
irrelevant.
trip, if you go on a trip to Vegas to go to like Mark Kohler's tax and legal 360 or something, you
Yep.
pay like 5 grand for that. You don't want Andrew to be on the hook for that expense. It shouldn't be coming out of his cut. So
Unless we
that
both
would,
go together.
unless you go together, then it's
Right.
then put it on the partnership. Totally
Yep.
fine. But then your separate meal expenses, put that on each other's 1120s,
Yep.
1120
Yep.
S's. So you could do that, and then obviously home office expense and the such. Pay
Yep.
kids out of pay family management companies out of each respective
That's,
1120s, because
yep.
you can't really do that in a partnership. It
Nope.
doesn't work well unless you're doing like guaranteed payments and stuff and make it all really complicated for
Yep.
everything. It's
Yep.
it's not worth it. I never recommend that.
Yeah. Yeah. There's so much. It's like they say in the training, it's a second bite of the apple. It's, the accountable plan, the board meetings. Oh, you can do that in the partnership anyway, the board meetings, the partnership. But yeah, the S corp just opens up so many doors and avenues for different loopholes and savings and tactics to take advantage of.
Hmm.
But dude, you answered my question. I was like halfway there, and I'm what is the proper accounting treatment? I don't want to steer a client the wrong way. It's one of those questions I've Googled and researched, and I couldn't find the answer. And this is a
Oh,
perfect answer. So thank you, sir.
sweet. I'm
Thank you,
glad
my
to
good
have
friend.
helped. Yeah. For I actually have one for you.
Yeah, let's do it.
I had a client that was in partnership with their dad,
Mm-hmm.
and this is actually kind of a sad story. So, I think dad owns what 40%. We'll just say 40%. Son owns 60.
Mm-hmm.
They made like I think it was like 200K. They had 50 grand in the account at one point,
Mm-hmm.
and dad went up to it, snatched it out of the bank account, and went away somewhere.
Oof.
So, from that, I don't think I had the information on the capital accounts handy, but I thought about maybe because if he just took it out of the account, then yeah, I mean that's theft first
Yep.
off.
Yep.
So technically, theft is an expense
Mm-hmm.
when it comes to businesses.
Mm-hmm.
So I was thinking, well, if it's 50K as theft, but it's from a partner, so then I'm like, well, we technically consider this a guaranteed payment to make it taxable to him? But then I remember guaranteed payments are for services rendered.
Correct.
So that's the issue. So then I'm like, oh, do I just reduce the guy's? I guess I would just reduce his capital account in that case for like what it's actually supposed to be like. But then, we'll say, I was thinking maybe do capital account whatever it is, whatever it was, and then just if it went negative, just
Yeah.
he
So,
gets the K1 on that for all of those.
so the way
But
that
then, oh yep.
go ahead, go ahead.
But then it brings the issues like if that's also an expense too, he's going to get the benefit of it being an
Right.
expense on his K1.
Right.
But because he left the partnership, I could probably figure that he's abandoned his equity position at year end, so it could technically be a sale.
I think
It's so much.
there's so much going on here, and here's a few things that
I
I'm
always
thinking.
get the hard ones, dude.
There's a
This
few.
is how I got really good at this stuff.
This is good case stuff, like good case scenario. There's
I
a
might bring
few.
this up to Mark at our next meeting, actually.
And I haven't been on. I need to hop on those. There's probably one happening right now. We're doing our own thing. Few things come to mind here. let's go P&L impact first. Let's say the theft is a deduction, okay, and it's an expense. Okay, that begs a couple questions. Do they have an insurance policy that covers property casualty that would cover this type of damage?
I don't think so, but they are in the midst of a lawsuit
Okay,
over it.
okay,
So
because
they do have actual like grounds and stuff, which is like crazy. How do you steal from your own son?
dude, that's why. Like, I know it's
It's
like
wild.
tough to like deter like get out of the emotional mindset and get into like the accountant's tax mindset right now because this sucks. Like, this is
Yeah.
your father and son. Oh my god. Um,
Mm-hmm.
but a couple things. The expense side, is it insured? Yes or no? If it's insured, then the insurance company would reimburse, and in theory would net out the the expense to zero. So it would be a wash. However,
Mm-hmm.
the father has $50,000 of free money. Um, you might be able to make a journal entry. If that happened, maybe make a journal entry where it's a distribution to the father. So his capital account decreases, and then you mark his K1 as final. He still has a positive capital account, but his capital loss, right? Because a positive capital account is a capital loss, negative's capital gain, right? If it's a final
Mm-hmm.
K1,
Yeah, if it's negative, it's capital gain.
right? So basically, lower his loss as much as possible by the 50 grand. So like he's basically taking a haircut. Basically, he's not. How do I explain this?
Yeah, I'd have to see their prior year return, which I've asked for. We'll see on the actual consult for that. But I mean, let's say it was like 25, then oh, he's got 25K in capital gains to pay now.
Correct.
So that
Correct.
would, yeah. So I was thinking that would be it. Um, that would kind of that would make the most sense for that. I do like the idea of making a guaranteed payment though, but I feel like no, that's too much. I would get in trouble for that one.
Yeah, I mean the guaranteed payment.
Because it's not a guaranteed payment. It's not.
It depends how, like you said, the operating agreement is drafted, and then it's like, all
Like
right, because
if I had actually if we had evidence to support him saying if he said anywhere that I'm taking this $50,000 for stuff that I did or something like that, then I would say maybe we have
right, guaranteed payment.
reason to believe that it's a guaranteed payment.
Yep.
But without that in like writing or a video evidence or something, I don't think I'm gonna be able to make that call.
This might be a good one for a call with Mark because he's a tax lawyer too, so he can talk about
Yeah,
the legality behind it.
exactly, because there's a lot of legal stuff in here too, mixed in with the accounting, which is like I feel like this is a really good like case study
Yeah.
for something like that. Because oh boy, it's emotional. And that sells right there
Do they
based on that.
have do they have separate S corporations that it flows into, or
No,
is it, yeah, so it's like, okay, guaranteed payment.
they also shut down operations soon after. So it's going to be the final 1065 for them.
Yeah. Yeah, so it's either going to be one, I think either the guaranteed payment or the distribution to the father, which both of them kind of screw him either way from a capital capital gain, capital loss standpoint. It's basically
Mhm.
minimizing his um his favorability in the partnership. Or the guaranteed payment. He gets hit for SE tax. I mean, it's
Yeah.
going to be one of those two.
I'm thinking that maybe we treat it as like a abandonment of the stock or something because I mean, you steal like he obviously broke an operating agreement somewhere.
Right.
Maybe. I'm assuming that he would have. Um, and if that's the case, then 100% ownership goes back to the son, and then anything after that would 100% be his.
Mm-hmm.
Uh, that might work. I'll have to plug around. I'll have to plug and chug into the software to see how it affects things,
Yeah,
and see if I can even like do that. Like that's where, like, knowing a good tax lawyer is really helpful
this is an
with that,
interesting one.
because these questions are the ones that really get you.
Right, because you don't
I
want
was
this
not
to.
prepared to hear about all this one. I'll tell you that
We,
much.
I mean, you think of like, all right, the father maybe passed away, and then you have the 754 step up or whatever, and those type of elections. But this one, it's like, okay, this is not what I was expecting.
Hmm.
I think treating it as an expense is not the right way because
Yeah.
the father took the money and ran, like good old Steve Miller said. Um,
Hmm.
I don't. I think this is just going to be, like you said, either a guarantee payment or a direct impact to his distribution of capital account, and it would lower his equity, and his final K1 will man it might put him in a capital gain position. Um, you really won't know. Is this a brand new client?
Yeah. No, we
Yeah.
just had a like little 15-minute consult,
Oh, okay.
and like they dropped that on me, and I was like, "Ooh." But I was
You're
like,
like,
"Yeah, I'll definitely help out. Let's book an initial consult and
yep,
let's get talking."
yep.
So, because I knew I could bring this up to Mark, and he would be like, "Ooh."
Oh,
I
he's
always
gonna.
get him with those. Every single time I ask a question, I always give him like I can stump him very, very quickly with the questions that I get the questions that I have from just the situations that I have.
Yeah.
And this is how I've learned, um, basically most of my tax stuff, most tax law, because I've put myself out there to learn about this stuff, because like you have to learn a lot just to understand
Oh
what's
yeah.
going on with this. It's
Yep.
insane.
Yep. It's kind of question why we do this to ourselves, but it's stuff like this, you want to obviously benefit your client in the most favorable and legal way.
Hmm.
Um, yeah, that's a fun one. If
Hmm.
I'm on that call with you, you got to let me know how that one goes, whether or
Oh,
not
I
I'm on
will.
that call.
Definitely will.
But good stuff, dude. I'm gonna stop the recording unless
Yeah.
you had anything else
No.
to add.
No, I'm good, bro.
All right, good stuff.
We're
I'm gonna stop it and then we can snip it up and
yeah, we can